Welcome to this Focus Deep Dive. Today, we're zeroing in on MSCI Inc., that's ticker MSCI.
Right.
We're going to be pulling out the key insights from their recent financials and reports, basically trying to understand where they stand now and maybe where they're headed. So the plan is to hit the highlights, the really essential stuff, all in, less than 15 minutes. Let's jump in.
Okay. Well, what's interesting right away, I think, is just how embedded MSCI is in the whole investment ecosystem.
Uh-huh.
People often think indexes, but they've got analytics, ESG, and climate, even private assets, 4 segments. They're touching a lot of parts of the investment process.
That diversification seems key. It's not just a side thing for them.
Not at all. It seems fundamental to their stability.
And that stability, maybe that's reflected in the stock overview. The report had the price at $538.48.
Yeah, as of the report date.
And the fair value estimate they calculated was $581.87. So potential upside there.
A bit of headroom, yeah. Though analysts, as usual, have a broader spread.
Right. The targets range from, $449 up to $642.45. That's quite a window.
It is. Shows the uncertainty out there. But that internal fair value estimate is interesting. It's based on their model, suggesting they see it as potentially undervalued.
Okay, and with a market cap around $41.79 billion, they're a major player.
Definitely. And central to understanding that valuation is their economic moat. The report calls it wide.
Okay, let's talk about that moat. What's behind it? The report mentions high switching costs.
High switching costs, absolutely. And intangible assets. Think about their brand. MSCI indexes are like the benchmark standard in many areas. Plus their specialized data. And the proof is in the pudding, right? Client retention over 95%.
Wow, over 95%, and recurring revenue at 98%?
Exactly. That tells you clients aren't just trying MSCI out, they're deeply integrated. Switching away would be a massive headache, maybe even costly.
So that's the high switching cost element in action.
Precisely. It's not just about convenience, it's operational disruption. And that recurring revenue, it gives them predictability, helps them ride out market ups and downs better than, say, purely transaction-based businesses.
Makes sense. Okay, let's shift to recent performance. Q1 2025 looked, well, pretty good based on the report.
Yeah, strong start to the year. 10% organic revenue growth.
Okay.
Adjusted EBITDA up 11%. And adjusted EPS grew nearly 14%. Those are solid numbers.
Definitely solid. What about the underlying metrics?
Still look robust. That retention rate, again, over 95%.
Yeah.
Very durable. Organic subscription run rate grew 8%.
And asset-based fees.
That's a really strong growth, 18%. The report noted help from international and non-ETF products specifically.
Okay, and this is interesting. Recurring net new sales growth. Index and analytics segments both over 60%.
Over 60% each, yeah. Huge jump. And private capital solutions also saw good growth, 24%.
Plus, they seem to be hitting the mark in growth areas. Custom indices, direct indexing, AUM there is up 30% to over $131 billion.
Right. And climate indexes too, AUM, up 50% to $387 billion.
So they're clearly tapping into some major trends. Customization, direct indexing, climate focus.
Absolutely. It shows they're not static. They're adapting to what clients are demanding now, these big shifts in investment strategy.
Which points to the resilience of their overall business model. The report emphasizes how their data and tech are mission critical.
And integrated. 88% of subscription run rates come from clients using multiple products. That entanglement builds loyalty.
Right, makes switching even harder. Plus strong margins, good cash flow conversion. It sounds like a well-oiled machine.
It does seem financially very robust. They even sounded confident on their earnings call about handling different market cycles. That cash flow gives them options too, reinvestment, maybe returning capital.
Okay, so a lot of positives, but no companies without challenges. The report did flag near-term issues.
Yeah, the big one being the market environment itself, just extremely uncertain.
Emerging market volatility, trade tensions, risk sentiment swinging around, the whole 9 yards.
Right. And because of that, MSCI themselves sounded a bit cautious about retention rates holding up at that high level for the rest of the year.
Understandable. Market downturns could pressure those asset-based fees and maybe cause some clients to trim costs, even for essential services.
Exactly. It's realistic caution given the macro picture.
And there were some specific segment headwinds mentioned too.
Yeah, sustainability and climate facing some regulatory uncertainty, both U.S. and Europe. And real assets activity was a bit muted, apparently due to client consolidation.
So even a leader like MSCI isn't totally shielded from sector-specific issues or regulatory shifts. important nuances.
Definitely.
Looking ahead, though, what about strategic moves? They seem active there. The partnership with Moody's.
Right, for private credit risk assessments. That's an interesting move into a growing, important market, leveraging Moody's expertise.
And they're focusing on evolving needs, active ETFs, fixed income.
Showing they're trying to stay ahead of where the asset management industry is going. Plus, momentum in custom indices, helped by their Foxbury F9 platform.
Right, that's their tech platform for creating tailored indexes, which is key for that custom growth.
Yeah.
Okay, what about the analysts? Sentiment seems a bit mixed.
Yeah, you see different ratings, price target adjustments over the last year.
Yeah.
From the big firms Goldman, Morgan Stanley, Barclays.
But Deutsche Bank upgraded to buy back in April 24.
They did, calling it a compelling entry point. Suggests some see value at current levels, despite the uncertainty.
And the average analyst target over the last 6 months anyway was $667.33. That's, well, quite a bit higher than the current price mentioned in the report.
It is. Again, reflects that mix of near-term caution, but maybe long-term optimism among some analysts. It indicates potential upside if things go well.
Let's touch on valuation figures quickly. Looking back from 2020 and forward to projections for 2029, that 98% recurring revenue is just so consistent.
It really stands out. And you see fairly steady growth trends in revenue and EPS over that period, too.
And looking at the valuation multiples, like the PE ratio, it seems relatively stable despite market swings.
Yeah, which might suggest the market gives them some credit for that earnings stability, that predictability from the recurring revenue. It provides a solid base.
Okay, so just to really nail down that economic mode again, it's driven by
high switching costs, because their stuff is so integrated, intangible assets, brand, data, and network effects, their indices being the standard means more people use them, which reinforces their position as the standard.
Right. Those three together create a pretty formidable barrier.
Very difficult for competitors to replicate that combination. Yeah, it cements their position.
So, main risks to keep in mind.
Definitely sensitivity to market volatility. That hits asset-based fees, could increase cancellations, and those specific cyclical headwinds in areas like sustainability or real assets.
Got it. Inherent risks given their business.
Exactly. Need to watch the broad market and those specific segments.
Okay, so pulling it all together, the report's overall take seems to be that, yes, there are near-term market worries, but MSCI's strong Q1, that resilient model, the growth drivers, it suggests the stock might actually be undervalued.
Yeah, that seems to be the bottom line. They also point to potential boosts from shifts to non-U.S. markets and just the general need for better analytics when markets get choppy like this.
So considering everything, MSCI seems to have significant strengths, a durable competitive edge, but it's operating in a tricky environment right now.
That sums it up pretty well. The fundamentals look strong, the growth paths are there, but the near-term macro picture adds that layer of uncertainty.
Right. So to recap the key takeaways, strong financials recently, that wide economic moat is crucial, potential undervaluation, but balanced against market uncertainties and some segment-specific challenges. Which leads us to a final thought for you listening. Based on everything we've covered today, the beta, the trends, the risks, what specific indicators would you personally track most closely to gauge MSCI's future performance going forward?
Good question to ponder.
We really hope this focused deep dive gave you some valuable insights into MSCI.
Hope it was useful.
And if you did find this analysis helpful and you want to keep up with more concise stock breakdowns and these kinds of deep dives, please do subscribe to our channel and hit that bell icon too.
Yeah, your support really does help us create more of this content.
Absolutely. Thanks for tuning in.